There is blind justice, and then there is trading justice, so that you can finally afford to get that laser eye surgery. Not only will people find you more attractive once you ditch those old glasses, you'll be able to see your charts better. That's what we call win-win. Speaking of winning, it's time for a little trading justice. Brought to you by TackleTrading.com.
Welcome back to the Trading Justice Podcast. My name is Matt Justice, along with my co-host Tim Justice. We got a special edition of the podcast today. We got Andrew Cameron. You guys might remember Andrew from the... Andrew, was it trading... was it episode 3, I think we did?
It was back it was right when you first started doing them. That's where I remember it was one of the first ones, but I don't remember which episode it was.
Yeah, it was
a while ago.
It was one of the first ones, and we talked a lot about high-frequency trading systems and high-frequency traders, and I believe you sent a shockwave throughout the trading justice community when you said 90% of the overall volume was just basically done by computers and had nothing to do with any human emotion in any capacity. But that was a fascinating conversation. I'm looking forward to another fascinating conversation today, not only with yourself, but I think I'm just going to say how Andrew told me. One of the brightest minds in the business, Dave Kosourek, is joining us here today as well to talk not only trading principles, but to talk about what's kind of going on out there in the marketplace regarding quantitative easing, the SNB shocking announcement from last week, and preparation for other central bank meetings coming out over the course of the next week or so. Andrew, how are you today, buddy?
Life's good, man. Life's good. You get a little bit of a day off. Market closed early, so we were hanging out looking at stuff this morning. But it's nice to have a little bit of a break before we get back at it. Trading full time.
When you say the markets were closed, the stock market was closed, but that's not what you guys primarily trade. What do you, Dave, primarily trade?
Well, we trade futures and Forex. So Forex today was still, even though it was just kind of a lighter day, just it would move up about 70 pips from the open this morning, Dave.
Pretty much, yeah. It was a low volatility day, but it's still there was some opportunity early on.
Yeah, I had 2 trades today in the currencies. I went short U.S. dollar, Canadian dollar, and I went long dollar yen pair. So I kind of did those 2 pairs, and small profit on the Canadian, still in the Japanese yen pair right now. But kind of in terms of your when you look at the currency market, how do you go about making decisions? And I want to speak specifically to Dave first here. How do you specifically make decisions about what type of trades you're looking to make in the currency market?
Well, we have quite a bit of proprietary automated trading systems that we've created over the years, and then we have the software also, so that is able to run those. So what we do is we're able to use this incredibly powerful tool to kind of give us what we call layup trades, or a lot of singles and sometimes doubles, but we get a lot of low risk, high reward trades from these different trading systems. So
are your systems technically based? Trends, patterns, support, resistance indicators? They're
100% mathematical and technical based. They all have specific parameters. Sometimes we have different types of trading systems running concurrently. So we have trending, contrarian. We have a bunch of market making type systems. So we're kind of those evil automated trading systems that Andrew was probably talking about, where we have very little human emotion involved with them. But we do overlay our 35 plus years of trading experience to control the outside variables, when to turn these different systems on, etc.
Dave, agree with this if you do, disagree if you do. I was in a class this past weekend teaching for Rich Dad Education. I was in New York City, and I was talking about the advent of high-frequency traders and whatnot. And I said, yeah, guys, listen, you got to realize these are computer-automated systems, but at the very beginning of it all, they are designed based on technical models. Would you agree with that?
Yes, I mean they pretty much all are. So you have to realize that, and people, believe me, a lot of different groups that I've worked with, they've tried to say, well, we want the 100% black box, which a black box system is one that just you turn it on and it trades automatically. So You still have to decide. A human being still has to decide when to turn it on.
Yeah.
And that's really the key, that even if you have a 100% black box automated system, it still needs some type of human intervention when to put it on. A lot of them also have, and obviously ours has many different layers of money management and different profits and stops that you could put in depending on market volatility, depending on what pair you're trading. So ultimately, you have to have kind of your act together on when you turn them on, how much you plan to make, etc. So it still is like trading. It's just meaning like
you're just not processing that. You're not putting the buy stop order, the sell stop.
Well, I also look at it too, where in the past I ran a hedge fund for a while, and I had countless charts open and different things that I followed, and stocks. I probably followed about 100 stocks, and then had to make all these different decisions. And so ultimately, I had to go through all those charts one by one. I had all my different areas and by sector set up, the 10 best, strongest stocks in each sector. So I would have to go through 10 different sectors, 10 stocks. So it's 100 stocks, and I would do that probably 50 times a day.
Yeah.
Constantly combing through it, where now the software does it for you and says, hey, buy this, buy that, this sector's hot, etc.
Let's take one step back real quick, because I'm fascinated by this discussion so far. In terms of prior to even running a hedge fund, Dave, how did, because I kind of know Andrew's story, because Andrew and I kind of grew up in this business together. But in terms of your specific journey, how did you get even interested in trading in the first place, even prior to running a hedge fund?
My background in college was actually an accountant, but I always loved computers and numbers. I was very good in math. So ultimately, I was a stockbroker, but I started trading. I love to trade, and that's when I started making more money trading for my own account than I was as a broker. And I was actually doing pretty well as a broker, so I stopped and just started trading full time. I had a couple clients and put them in kind of in a hedge fund format, and had some pretty amazing returns in the multiple hundreds of percent. So I knew that I had a trading system. So the next step after that was to put it and computerize it and make it all not 100% black box, but to definitely get it going in that. I knew that's where we were going. This was late 90s, early 2000s. Yeah. So I knew that that's the way we're going. And so ultimately, once I put all the code and things together, it really opened up my world to literally create. It's almost like a game world, or a gaming style strategy, where you can put in so many different. In gaming, I mean like computer games, not casino games. Although there is a bit of piece of that too. If you
I completely understood where you were going with that.
Percentage chance on statistics in that.
No, I'm teaching my son how to trade. Well, trying to. He's lazy sometimes. But as I teach him how to trade, I really kind of approach it as a game type perspective, because, kids are gamers these days. He categorizes himself as a gamer. So I completely understood where you're going with that, and agree with you 100%. In your estimation, what is the primary difference between what you do today, running a fund, auto trading, high frequency trading, and whatnot, in comparison to what you were doing as a broker? What were the limitations as a broker compared to what you're doing? Because I think people would. There's a lot of our listeners who have a broker that is basically managing 401ks, right? And that's kind of where they understand what the market is. Right. What are the limitations that a broker has that someone like yourself now doesn't have to deal with?
A broker is basically a salesperson. I mean, just in general. I know the industry's probably changed a lot since I got out of it in the late 90s, but a broker is a salesperson. And so there was also obviously the regulatory and compliance department that had to manage all that. So you had so many restrictions and that. So really your time is focused on hand-holding your clients and all those different things. And then the trading aspect, which to me is the 100% driver of any type of business in any field in finance. I mean, if you make a profit successfully with low drawdowns, you will be the master of the universe. So that is kind of the ultimate goal. And I think as a broker, you've got way too many other things to do to even think about trading. to think about getting investment. And then what they do is they hand it off to an investment manager, which it's in his best interest to what? Not blow up. It's not really, they get paid for assets under management. As long as they don't blow up and can continually collect assets under management, they just keep getting a bigger and bigger fee. So if they underperform the market, they still bring in money. You hear all these funds that have made the S&P's up 10% for the year and they made 3%, yet they have $2 billion under management. Well, you do the math on it. They're still, the managers are making tens of millions of dollars. And they're underperforming the market. So I don't know. To me, a job like that where, hey, I'm going to come in, I'm going to underperform. It's kind of like asking your kid to do something. He does it wrong and it takes a long time. I don't know. You might want to straighten them out a little bit.
Yeah,
right?
And I know Tim wants to get in here real quick and ask a couple questions, but I do have one last question regarding the broker status. When you are a broker, and I completely understand, you're a salesperson more than you are a trader, but you are still trading. You're just trading a different account, a different type of setting, correct? You're just not trading in that same fund.
Get off the sidelines and take control of your financial future at www.tackletrading.com. Get in the game.
You've been listening to the Trading Justice podcast presented by Tackle Trading. As that nice little sexy voice says, get over there to Tackle Trading and get in the game. We're sitting here with Dave Kosourek and Andrew Cameron. Dave had to jump off for a little bit. We're going to continue the discussion here with Andrew. Andrew, we were talking a little bit about the differences between how brokers approach the market versus what you guys are doing now, what a lot of other active traders do. Looking back in your career that spans, a good, 12, 13 years now?
Close to 15, yeah.
Wow.
Yep.
Time flies, brother. Time flies. What is the primary difference, how you approach the markets today versus what you were doing in, 04, 05, 06 when you first started?
Well, the first thing I've noticed, and I am fully licensed now as a broker, so I have dealt with this even as of recent of just the last couple of years. It's speed of execution. Mm-hmm. If you get an idea, if you even go back 5 or 6 years ago when I was dealing a lot with clients, before I would ever place a trade, I still have to get their approval. So, you're still having to do discretionary. You can have discretionary or non-discretionary accounts. But normally you still have to make the client aware just for your own fiduciary responsibilities with the client that it's a sound investment for them. So speed of execution is one of the major things that you're doing. If you're placing your own trades, if you guys get on, TD Ameritrade or whatever platform you guys recommend people use or whatever, you click a button and you've got an order confirmation there in, seconds. Well, it used to be that even with a broker, I wouldn't get my order confirmation until the end of the day. Yeah. That order was filled. So I didn't know price. I had ranges that I would give them. And from the time I made the call, talk to the client, actually placed the trade, you're still talking 10 to 15 minutes on the low end and upwards of all day long. So you got to be, I'd say one of the biggest changes has been speed of execution. On the other side, as it relates to more systems-based trading, when we get signals in our trades now, our average length of trade, I believe last week was about 8 minutes. Yeah. So it's not only execution on getting into the trade, but if I've got to wait 10 minutes to get a confirmation for my client to even place the trade, the move's typically already happened. So really having a sound system and sound rules and that whole idea. And then once you get out, you have to get confirmation from the client. Again, same process all over again. Mm-hmm. So that's one of the major shifts I see with just technology alone is just speed of execution of trades, would be one of them. And also the tools that are available, even as a broker, we may use a simple MACD, we may use one or two simple moving averages, but that's really all the tools we used as brokers to make decisions for clients versus now, you go through and click on a drop-down menu, and as it relates to different indicators or different trading systems, you've got hundreds of options for, whatever style trader you are, mean reversion, trend trader, multiple time frames, things like that. It's just, the technology's come a long way. the charting side.
The evolution of what we do from a charting perspective versus what we were doing a decade ago, you can't even compare the two. It's absolutely astonishing. In fact, you mentioned back then indicators, MACD, stochastics, RSI, and whatnot. They were very, very popular back there 10 years ago, and they've kind of taken a back seat to trend analysis, pattern recognition, and other forms of that you just mentioned. In fact, and I don't want to get too detailed into the algorithms that you guys have because I know they're proprietary, but at the same time, do indicators like the traditional MACD, do they even play a role in your algorithms?
No. All the criteria that we use is all math. Time versus price durations is really what we're focusing on, and then standard deviations of price. The one thing that we've seen a major shift in, and when we discuss the markets on a pretty regular basis, is the market is designed to trick people.
Yeah.
And a lot of times when you're getting MACD signals, or stochastics-based signals, you've got algorithms out there that know other people are looking at those tools.
Yeah.
So they almost, in a sense, fade those indicators, realizing that the uneducated retail guy is going to be looking at those for a potential trade, and they want to basically take the other side of that position.
Yeah, so as they come in, they start taking the other side of the position, then start funneling liquidity into the market, driving it back down.
The other side of it too, though, kind of tying back into patterns, is because if you guys watch high frequency trading, we watch high frequency stuff all day long. We recognize as the volume stepping in, there is literally no what's the best way to say it? There's no emotion at all in algo-based trading. Mm-hmm. So you may get the S&P to drop 10 or 15 handles, and everybody's looking at it going, holy cow, this thing's falling through the floor. And all it's doing is putting in a short-term bottom that those high frequency, they're basically pushing the market where they want it to go. Mm-hmm. So they're taking advantage of that human emotion. They're driving the market one direction, knowing that they're going to take out all those stops. They're gonna get rid of all the sellers or buyers, and then they're going to take the market the direction that they want. We see that day in and day out.
Mm-hmm. And in that environment, when you have the normal average consumer investor, how do they even flourish? If not, how do they even survive in a marketplace where the rules are really based around them losing money?
Education.
Yeah,
it's one word answer, and I believe in my thing, and I always like to quote Benjamin Franklin when he says, tell me and I'll forget, teach me and I'll remember, involve me and I'll learn. Mm-hmm. You've got to be involved in the process of the education. Going out and reading a book, you're never going to make money off that. Mm-hmm. The only person that makes money on books is the author. So, keeping that in mind and getting a good mentor, surrounding yourself with traders that are better than yourself. Mm-hmm. is extremely crucial.
Honestly, I obviously agree with what you just said, but if you try to go out there, and I even told the traders out there in New York this past weekend, I said, if you guys think you can come to a 3-day seminar and go compete with the likes of the high frequencies out there, the likes of the pros out there, that's the best thing that has ever happened to people like us. Where you think you can go to 3 days and say, go compete with the likes of the Andrew Camerons and the Dave Kosoureks and the Tim Justices of the world, people who understand how these models are designed and built, and then they wonder why they just lose money. But if you can invest in yourself to the point where you educate, where you surround yourself with people like yourself and me and Tim and Dave and other traders out there, that you can not only learn to compete in this market, but you can thrive in this market.
We very regularly, and I've mentored a lot of people over the years. We've got people that we've worked with that consistently right now in this market trading futures are averaging $250 to $1,500 a day right now. So I think as a from our own trading, I think we $960 on Friday alone. Mm-hmm. Across the board, and that's really just surrounding yourself with great traders that can explain the market and can help you walk you through the screen time. Because that's the one thing any trader who really is a true trader will tell you, where you learn is sitting in front of a computer screen.
Absolutely.
And actually doing it.
Well,
agreed.
Let me jump in real quick here too, though. I think the biggest thing is having the right tools, but also knowing how to use those tools. So you can go and get any amounts of thousands and thousands. I think if you Google search it, you probably get a million different trading systems that you could actually go out and purchase right now, or get signals or whatever. And I think the biggest key is being able to stay close to the market and using the tools in the proper way, which nobody really explains, in my opinion, the right way, where, okay, you've got this incredible, powerful system, but in my past experience, I sat next to guys, I had a good system and I was doing very, very good returns. And the guys sitting next to me would put on the same trade and they end up with having a losing day. I mean, there's so much more involved with trading than just buy and sell. There's emotions. There's any level of different personal situations that can occur. If you come in and you're tired, if you come in and you're out of it mentally, you're going to fail. It's just that kind of thing. So you really have to put your game face on, bring your A game, and then you're able to really be powerful and trade from the right spot, and you will then do pretty darn well.
Well, at the end of the day, guys, this is a highly professional business. And if people come into this business thinking they can nickel and dime it and treat it like a hobby, they're going to be treated that way. You have to treat this like a professional. This is a business, and you have to act that way. And if not, you probably shouldn't do it in the first place. All right, guys.
It's the same thing with people that try and go in and do something, and they're like, well, I'll just do it like 2 to 4 hours a week. Well, I mean, if you had a regular full-time job and you work 2 to 4 hours a week, you're going to get paid what you get paid,
That's a good point, actually. Hey, I want to kind of shift the conversation very quickly, and I want to get Dave's take on what the SNB, the Swiss National Bank, did last week.
Yeah, me too.
And just to make sure everybody is aware of what the Swiss did last week, they did two things in announcing their monetary policy. They're a central bank that covers the Swiss franc. The first thing they did was unpeg the franc to the euro, which has been pegged at $1.20 euros for the last, Dave, since 2011. And they also lowered their interest rate even further into the negative territory by lowering a negative 0.5 percentage points again to a negative 0.75. Dave, I was shocked by what the Swiss did. I was not, just in terms of acting as far as they did. It didn't, in a singular sense, unpegging made sense to me. In a singular sense, going to a negative interest rate made sense to me. But in the combination of the two, I really could not understand why the Swiss did what they did. So I want to get your take on what the Swiss did and kind of your understanding of what led to that decision.
To me, it seemed like that. Well, first, let's just explain. They had pegged back in 2010, 2012, there was the European credit crisis. A lot of these peripheral countries, Portugal, Spain, etc., had exorbitant interest rates, well over 10%, let's say, and so they were really struggling, and the euro was basically falling like a rock at that point. And especially some people look and everyone thinks about, especially if you're U.S. centric, you think that everything in the sense of U.S. dollars. But when you look at some of these other currency pairs, they trade. There's the euro versus the yen. There's the euro versus the Swiss franc. There was the euro against the Great British pound. So when you look at all the different cross currency effects that were going on, the euro versus the Swissy was plummeting at such an effect that it was literally crashing and dragging stock markets down. It was dragging risk down. So ultimately, they had to peg it to stop that from really killing the euro. So they basically saved the euro by pegging it to a stronger currency, which the Swiss are. Their economy is strong. They're wealthy, etc. So the bottom line is that once they put that peg on, obviously someday they were going to have to get rid of that peg. They couldn't keep it forever. So in my opinion, they feel, as you've heard, the U.S. Fed has tapered till they stop doing QE. The markets are at all-time highs. You would think that if there was something that was artificial, if this would be about as far as utopia as you can have. So if you were to do something like stop doing a peg, this would be the best time because the markets can handle it.
Yeah.
Realistically speaking, many billions and billions, probably even $1 trillion was lost on the move in 5 minutes.
Yeah, that's what I wanted to get into next, Dave, because, with algo-based trading, the high-frequency stuff where you turn the computer on, I'm sure with the leverage of the Forex market and the ability of these computers to make those trades, there was a lot lost. There was probably a lot gained by certain people as well. Like, how do you model in black swan risk, things that we haven't seen?
Well, my point was that they said that they had just put out that the Swiss National Bank had made about $40 billion last year. But then on this currency move, they lost $100 billion. So but in my opinion, because their currency went up, that everything they own is in Swiss francs. So realistically, it was pretty much a wash for the Swiss. But for other firms, most likely the people that were doing that trade, meaning most people would buy the Euro Swissy because they knew the peg was there, someone had their back, so they were in this artificial trade. The thing is that once they pulled that plug, that if you had an account, hundreds of firms, as we know right now, a good handful of firms have gone under, and then countless, probably in the hundreds of macro hedge funds, especially in Forex funds, blew up. You just don't know yet. So it's kind of like I say, it's like the earthquake, and now the water's going to start going out, and you're going to hear the wave coming pretty soon of all the different firms that went under. But if you think about it, that kind of hit, I think, can be handled right now in the euphoric, near all-time high stock market, and the Bank of Japan is printing like crazy. The ECB is going to start printing coming up probably this week. And if not, they're going to be committed that if something happened, they're going to print, which is basically what they've been saying for 2 years. So I think, are there firms that went under? Are there banks that lost hundreds of billions of dollars? Yes, but in the whole scheme of things, they had to eventually pull the Band-Aid off, and they did it last week. I think the other thing too is that it really took out a lot of the smaller retail people, because usually those type of big momentous things were typically done on a weekend where most guys would be flat. Yeah. So there was kind of a shot across the bow of speculators, which it is what it is. So if you're a short-term speculator and you happen to be trading those pairs when that thing hit, you either got lucky because there's nothing in the charts that said to go that other way, or you were unfortunate.
Actually, I trade the dollar franc quite a bit, and I was not in a trade on the dollar franc that day, but I do trade the dollar franc quite a bit. And I was looking at the chart the next day, and I was looking at and there was nothing in the chart that indicated you should have sold the dollar.
Nope.
There was nothing. In fact, the intraday chart was going up. The day charts were going up. It was high basing on the daily chart. The only thing you might have done.
The U.S. dollar has been strong in freight trading lately. So it was definitely all systems go. If you were to be in a long macro hedge fund, you've pretty much got your head ripped off. There's no way around it.
Do you think that one of the things that kind of led the Swiss to do this was every time the franc euro pair got to that $1.20, the Swiss were forced to buy the euro. With the widely anticipated announcement coming on Thursday that the ECB will announce at least a $500 billion quantitative easing program, do you think part of the reason the Swiss acted as they did last week was because they knew the impact to their own bottom line if they had to continue to buy the euro in an environment where they're printing enough money, as much money as the Bank of Japan is?
I think that the euro is not going to have to print as much as people think they will. Mm-hmm. I think the numbers are going to be a lot smaller. I wouldn't even be shocked if they don't do it this coming week. Mm-hmm. They keep jawboning because they don't need it. The interest rates are already at 1-2%. The Spanish bonds are less than the U.S. Treasury, so or close to it. So I don't think they really actually have to do it right now. but I also think that they've had to defend the peg for all these years, and they still were making $40 billion a year. So I'm not so certain that was the reason. I think it's just saying that they wanted to go back and be the smart conservative country, and this was the best time to do it.
At least there's one of them in the world right now, right?
Right.
Yeah.
I mean, if you think about it, where would you put money? As if you had $50 million, you're worth $50 million. Where would you put it? In a CD at 0.2%? I don't know. I don't think so. I think you go with gold, you go with the Swiss franc, and you go with the U.S. dollar.
Yeah. No, I absolutely 100% agree with that.
As a currency, I'm not saying as an investment. I'm just saying so you can get your money back someday.
Yeah, exactly. I know. I totally get what you're saying. I do want to talk about something you did say about the euro, though, because for about 6 months now, the euro has been pricing in quantitative easing. And let's say in the scenario that plays out that the ECB announces that they are not going to do quantitative easing this time, how does the euro specifically respond if the Europeans on Thursday do not announce quantitative easing?
I think the euro goes up for 3-4 cents. I mean, there's no doubt about it. It's priced in. It's dropped pretty precipitously the last month or so. So I think they could also what's been pretty much going on so far, which is we might do it in a smaller scale. I think they announced a smaller scale, or they might not do it at all. But either way, I think most of it is priced in. Yeah. And ultimately, once they go ahead and do that, then the market can kind of move to where it needs to move to. I mean, obviously, they want the lower currency, which helps their exports, but right now it's getting a little bit too fast. Honestly, same thing with the Swiss currency. You know, when you look at the euros drop 10 cents in the last month or so, a month and a half, that's a lot. That's the same move as happened the other day on one day.
Yeah, in terms of, let's again go with the scenario they don't do anything. I don't know if anybody knows for certain what they're going to do, but let's say they don't do anything. I honestly believe that is a massive opportunity to buy the euro. If they make the choice not to do anything, you're going to have a because I agree with you. I think a lot of the QE is priced in. So if they do something less than the market expects, or if they don't do anything in any capacity, I believe the euro is going to go up quite a bit in the short run.
It's the kind of thing where you have to look at it where how does the market react to news, and in this case, if they do it, it's pretty much already priced in, so it'll meet expectations. I think the euro rallies. Mm-hmm. If they don't do it, I think the euro goes crazy to the upside. So either way, I mean, there obviously will be volatility. I mean, it could be trading at 115 and print down to 114 or 113 after the announcement, and then close that day at 116. You know, there's going to be huge volatility for sure, but ultimately it is, I think, priced in. And well, let's see what the market does with that.
It sounds to me like your personal belief, based on everything you know about everything that's going on regarding quantitative easing, what the ECB is going to do, bonds, everything, that the most likely scenario is huge volatility. But if you had to put a gun to your head, you would say euro rallies.
Yes, for sure. For sure.
Now, the one thing, Matt, that you got to ask Dave is how would he trade that? Because
that's obviously the second question. You know.
Yeah, Dave's approach to that is he's probably going to synthetically trade that or spread trade that, right, Dave? Mm-hmm.
I'm sorry. Can you repeat that?
So if you how would you trade that? Because you would either synthetically trade that or you'd spread trade that euro trade, right?
I think at this point, you could do either way on being able to take advantage of the moves in the market, but you really have to be all hands on deck. It'll be fast moving. A lot of times that's almost too much move, so you just got to wait and let the dust settle after about half hour, and then make your trade.
So I want to make sure everybody is crystal clear on kind of the approach here. You do not get in front of the announcement, correct?
Correct. Yeah, unless you want to get your head handed to you.
Exactly. So you don't get in front of the announcement. You wait to see the initial movement, and then maybe get in after the first profit-taking episode.
Correct.
Okay, and you're saying that's probably 30 to 60 minutes after the announcement.
Yeah, I mean, it might be sooner. I'm fast, and our software doesn't. So what happens when moves are going on like this, a lot of these different market makers and things like that, the actual software goes down. So we have institutional strength connections, and so we're able to stay in the marketplace, and we can literally pick off some of those different possible price patterns, and that's pretty much what banks do anyway. Yeah. So.
What and I know a lot of this is done automated, but when you're tracking the chart, what time frame of a chart are you typically looking at on an announcement such as this?
I'm sorry. Can you repeat that?
Oh yeah.
Yeah. On an announcement like this, what time frames are you looking at for movements?
I would say in the short term, you got to go to 5-minute chart for sure. Even a 1 minute right away.
Okay, so
but primarily a 5. We primarily deal
primarily so 5. Yeah.
Yeah, Dave will normally look at 4 hour, 1 hour, 30-minute, 15-minute, and then 5-minute. Mm-hmm. Tends to be the durations that we'll look at when we're looking at the overall markets.
Yeah, and then drop it down to a 1 minute just to see the initial movement. Type thing.
Yeah, and then you'll see the spreads open up quite a bit, and that's the difference too. Is especially on retail accounts, if you're dealing with like a retail broker, you'll see those spreads widen, and that's the other part with using institutional fixed connections. Is we're tapped right into the liquidity, so those major spread movements like that, we really don't see that per se because we tap right into liquidity. So and our systems don't go down, so we'll actually, in a lot of cases, we'll see price fluctuations. You guys have all seen it right before the news announcements. Charts will go down, software will go down. Where with ours, we can get those quote feeds directly to the market.
When the PIP spread widens the way it does during an economic announcement, for the retail investor, I mean, you can see up to 10, 12, 15 PIP spreads.
Depends on the currency pair, but yeah, I've seen the euro as wide as 20.
Yeah. Well, I mean, there was, even on the euro just like last week, I think the euro got like 15 pip spread at one point. Man, you could not, even after the announcement, once you started trading again, once everything opened up again, after the Swiss did what they did, you were still dealing with, oh God, Andrew, what about, there was like a 50 pip spread at one point.
Huge. It was huge.
The Swiss. I mean, you can't justify getting into a trade as a retail trader at that point. At the institutional level, that's different. But as a retailer, you kind of have to wait for the volatility to somewhat subside before you start getting into it again.
Yeah, absolutely. No, there's no question about that. So the other side of it too, and this is one of the things that Dave will look at pretty regularly, is he may not necessarily trade their Euro USD. Mm-hmm. Because of that increased volatility, it may make sense to trade that against other currency pairs.
Like in a cross pair?
In a cross pair, or synthetically trade the euro. So, be long the euro yen, but be short another pair to offset that risk. Because that takes a lot of that volatility out of that move as well.
So in terms of that synthetic, you'd be like, so say you're long euro, short yen. Okay.
Yep.
But then you in another pair that is less volatile, you would actually be short euro.
Yes.
Gotcha, and that would offset the volatility in the euro yen pair.
And that's generally how we trade when we look at the carry trade. Obviously, that has a major effect on the S&P. There's a very direct correlation with that, and so we'll look at the carry trade as a driver. It's actually really cool. We have a chart that overlays the carry trade to the S&P.
Yeah.
And if the carry trade's rich to the S&P, 90% of the time it'll pull the S&P up to the carry trade.
Yeah. And because I get what you're saying there, but let's take that a step further, because I think the listeners will want to expand on what you're talking about. First of all, explain what the carry trade is to the listeners out there.
Carry trade is the U.S. dollar against the Japanese yen.
Yeah.
So if you understand what's going on, the Japanese yen, with all of their purchasing power, they're basically putting that money into the U.S. markets by owning the U.S. dollar. And instead of parking that money in bonds, which there's no money there, they're actually buying equities. Mm-hmm. So where do you buy? You buy the S&P. That's a lot of what we've seen on why the S&P's been rallying, is because you're getting all this money from Japan coming into the United States. Mm-hmm. So what we're saying when we look at the carry trade, we're looking at the U.S. yen to see is it rich to the carry? Is the carry trade higher in value, relative strength on a chart compared to the S&P? Because if it is, as that money flows out of the London session into the U.S. sessions, you'll see that money. You'll see that drive the S&P higher.
Gotcha.
Very, 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 very direct correlation with that. So as those other markets close, it's a nice lift on the markets.
So basically, the carry trade, to kind of sum it up, is basically people will sell the yen, buy the U.S. dollar, carry a positive interest on that.
That's right. And then what they'll do is they've got to park that money somewhere, not just necessarily interest, because right now interest rates are pretty much zero. But what they're doing is the flight to quality. They're buying. They're getting the increase in the value of the U.S. dollar against their own currency. Mm-hmm. And then what they're doing is they're putting that money into something, right? They're not just letting it sit in cash.
Yeah.
So they're buying the S&P. So they're getting a double bang for their buck. That's why when this market unwinds, you're going to see, obviously a lot of those funds from overseas that, they're getting clipped both ways, right? They're getting clipped on the carry trade as well as the S&P. So it'll unwind very, very, very quickly. Just from that posture.
The carry trade, what a lot of people don't understand, it's probably the number one trade in the world.
It is.
In terms
right now it is.
Yeah, it's like, I think it was like $14 trillion or $13 trillion worth of carry trades out there. Most of them revolving around the U.S. dollar. But historically, the carry trade, because I agree with what you just said right now with the yen, but historically it was about selling the dollar and buying emerging market currencies with higher interest rates. How often does as you approach the carrying the positive interest on the daily basis, how often do you change from a fund perspective what you are going to carry and what you are not? Because right now it's the yen, because the Japanese have been printing so much money that it's their interest rates are near zero. But how often do you change exactly what currencies you personally are going to approach on the carry?
Well, it was always the flight to quality was always commodity based currencies for a long time. You were going to go CAD, Aussie, New Zealand. You were going to do something there along those lines, because as well as emerging markets, just because you were getting the interest rates. But being commodity based was one good play that a lot of guys would do. Now the problem is the Aussie dollar is just getting destroyed too. Yeah. So and with oil prices being where they're at, they're just hoping that the $700 million a year or whatever the number is, 700 million or whatever the numbers are for economic spending to increase with the decrease in oil values. That's really what they're looking at right now.
Get off the sidelines and take control of your financial future at www.tackletrading.com. Get in the game.
You've been listening to the Trading Justice podcast presented by Tackle Trading. We're here with our guest, Dave Kosourek, and Dave has been talking to us about what happened with the SMB and the Swiss franc last week, kind of why they made that decision, how the euro and the Europeans are going to respond this week, and kind of high-frequency-based trading systems in general. Dave, it's been an absolutely pleasure to have you on the podcast. So
a lot of fun.
Thank you very much for coming on here and educating the listeners.
Thanks for having me.
And I'm hoping we have a lot of conversations in the future as well, Dave.
And Matt, I want to hop in here and ask Dave a couple of questions, if that's cool.
Go ahead.
Yeah. I mean, Dave, I'm coming at this from an angle. I'm a personal retail trader. I trade from my house and my office here in Salt Lake City, Utah. But I also mentor and coach, and I have a lot of individual traders that I teach, and they're of all different demographics, ages, all different walks of life. They hear about the Swiss franc news, and they look at the volatility in a market, and it can scare them, And when they're building out automated trading systems, whether they're gray box or black box or whatever, I mean, what advice would you give me as a mentor to work with, as I'm giving those people advice or them directly, on how to deal with this kind of volatility when they're building their businesses?
I think you really have to educate yourself on what's going on. There's a lot of different different news media or internet-based informational sources that if you went and listened to the normal business channels and read the Wall Street Journal, you probably would have been blindsided, because it's not in their best interest to even talk about some of the stuff, because a lot of it is pretty much saving certain marketplaces. So it doesn't fit inside the idea that everything is hunky-dory and we're at all-time highs when they're doing basically the Swiss National Bank was doing an emergency stopgap measure at this point. And so is, when you were talking about Japan, they're doing as if they were in a complete, utter crash crisis. So I think you just have to educate yourself on what is really going on out there. You have to look at different alternative medias. And I think you also have to look at, once you see and hear what is going on, that you're probably best bet. You're not an institution. You don't have the top-notch news flow and things like that. Then you probably should stay out of the sandbox if there's a bully in it. So typically, I have not traded the Euro Swissy, which I used to trade a lot, and also the US Swissy since they put the peg on. I knew someday they would pull the plug, and if you were in that trade on the wrong side, you're out. You have to realize there were some brokerage firms where their clients had negative account balances. So if you're trading more than 4-to-1, which is pretty typical in the Forex industry, your account was negative, meaning if you had 50 grand in your account, now you owe the firm money. So that's the kind of stuff that really you should want to stay away from that. And so I think if you don't know what you're doing in certain areas and know about certain currencies and things like that, either get the knowledge or don't play. I mean, that's just the bottom line. You're not going to go in and perform surgery on brain surgery on someone and you don't know what you're doing just because you took a class on how to use a scalpel. It's that simple, basically. So I think that being said, there still is an incredible amount of money to be made using the tools and playing in the other areas that are a little more stable. And so I think that kind of getting the package deal of the education, software, things like that, and especially some of the tools that you guys have, that's how you can actually get ahead of the game and be profitable in the game. But you have to realize that most of the banks and most of the larger firms and funds are doing the same thing. When their buddy at Goldman Sachs says, "Oh, we got this new strategy and we put it on and we're crushing it," well, they tell their friends, and their friends at JP Morgan do it. So eventually it crowds out quickly. I've found the half-life is probably about 2 months, and then 4 months it's gone. So a new strategy, the market seems to be always moving, works for about 2 months, and then it starts to fade on the amount of profit that you make on it, to a point where sometimes 6 months in, it's actually a losing proposition.
Yeah, I've talked to a lot of... go ahead.
To answer that kind of question on the... Sorry if I'm rambling, but once I see that if I have a system, you have to kind of play it 100% out, but I think you have to go in the shorter time frames, because when people say, well, it's day trading and it's risky, and I'm thinking the exact opposite. For a person to outperform the market and really hit it out of the park, what are you going to do? Find the next Microsoft or the next Apple stock or get in an IPO? I was talking with a group of people over the weekend, and they were talking about trading in IPOs, and I said, what are you going to do? Wait that 3 times a year where you actually get an allocation? And you never will really get an allocation unless you're an institution. So the game is really to stay in the shorter term, to protect yourself from some of these crash type scenarios, flash crashes, things like that. You can still be profitable, make money if you keep in those shorter time frames and just be smart about it. Obviously, you always have to have stops in, and so you don't have to take that blindside hit, and you can outperform the market and make a incredible living off of it.
I find what you said there very, very interesting in terms of reinventing systems and that kind of thing every couple of months. When you're an algo trader, even if you've got something that's really in the pocket and grooving right now, making you money, dialing it in, you're still developing, right? You can't stop developing new models.
Correct. I'm constantly, I mean, I look back and I have well over 100 different trading systems, and they can stop working and come back. A lot of them, it's not even that they stop working. It just you only have so much capital, so you might as well put your best foot forward. So that's typically what I see. Things ebb and flow, and so once it's working and working well, you hang on to that until it starts to not work as well. It doesn't necessarily have to lose, but there's always ways. It keeps you kind of sharp too, to always be reinventing yourself and reinventing your system, reinventing how you really make profits, and how and really has to be tailored to your trader psychology. So if you know about just manual trading, that the number one most important thing is trader psychology. I think Andrew and I joke around about it in the trade room. It's 99% pretty much in your head, and then 1% actual. The actual system or whatever. We can take trading systems that are losing systems, that lose, let's say, 60% of the time, and still turn them into winning trading systems. So based on money management, based on different things that we can do to minimize the risk. So
yeah,
but it really is all trade psychology, and it's the same with trading systems. It's no different, and that's where I think people are like, I'm going to go and buy the system, and it's got a 10-year track record, and it's profitable. I'm going to flip the switch, and I'm going to go to the beach and make money. You're pretty much certain to lose.
What you said there is actually something I've seen over the years. I've worked with a lot of traders. One of the things about trading by yourself, there's an appeal to it. I can be in my basement. I can be on the beach. Like you say, you've got that image in your head. But if you don't have somebody that ever checks in on you, looks over your shoulder, what if you're sick or depressed or angry? What if you have a bad day? I mean, it's psychological in nature. So when you build a team, like you have an Andrew right next to you, that's invaluable. I know having Matt on my team, we're brothers. We've been doing this together since we started. So that's invaluable to have somebody that that can say, okay, Dave, what's going on with you today? You don't look well, or maybe you need to get some sleep. Let's call it a day. How important is it to put people around you to make sure that your systems are working?
I think it's more of like the swim buddy thing, like basically what you're saying. You're going to get into a situation where something happens. There might be a riptide. So in the case of the Swiss, you might have been in a trade or something, or someone might have seen something before that. Some of the clues that I had seen prior to this, it was not a shock to me that they did it. Two reasons. I would look probably a couple times a week at the Euro Swiss pair, and it would always get down to 120.5, and then it would bounce up to like 121. Easy money. You just knew you could bid it there. You knew the Swiss banks were going to come in, and anytime it got lower. What I noticed, it was like almost when you drop a ball, like a rubber ball, and it keeps going, it bounces, and each successive bounce is lower and lower. You look at a chart on it, now that's kind of screwed up because of the big move, but if you can zoom in on that area on the chart, you could see that it was trading like 120.05, like 5 ticks off the peg and it wasn't really bouncing. So someone definitely knew, but by that, someone might catch that, tell you, and keep you out of it. So it's good to have a trading partner. Obviously, with what you guys have, you have a trading. More than one trading partner. You have an entire ecosystem that can help keep people out of trouble. So that's highly, highly recommended. But it is good to be on your own, because you aren't skewed by if you're at a bank or in a trade room and you kind of start doing this, everybody starts doing the same thing. Well, sometimes everybody does the same thing and it's the wrong thing to do. So there's pluses and minuses to it, but if you can have tools or a network community like you guys have that can help in trading, but at the same time you're an independent thinking organism that can go and use your talents and skills, and not everyone is going to be a scalper, or not everyone is going to be a short-term high-frequency trader, or not everyone is going to be a swing trader or an investor. I mean, you really have to tailor it to your personality fit and your psychological disposition. So I think really it's a kind of thing that it's a work in progress. It's how much work you put in is how much money you're going to make on the back end of it. Because people always ask, well, how much time do you spend? You don't want to know. I'm on the screens, probably easily 14 to 16 hours a day.
You know, I want to step away from the mechanics of it for a minute here because you've got me really thinking about this. And there are a lot of conversations going on around this world about algo trading and high frequency trading. And you see it in the news media. You see different opinions of it. Do you think at some level this system that is developing and is growing, it's organic almost, and it's not going away, does it pose systemic risk to the economy? I mean, are there real risks there that these computers could blow up and cause some disruptions that may not be able to be healed?
Absolutely. We saw it in the flash crash, and we're definitely going to see it again. I mean, you may not realize, but like I said, there are alternative websites and stuff that do track a lot of these different things, and there's roughly between 2 and 10 flash crashes in individual stocks every single day. Flash crashes, it has to be halted for trading. I think it's a 10% move or whatever in basically a split second, like one print. So even Apple recently had a flash crash. So I think ultimately you have to realize that the way the system is in place currently, pretty much the volume, and we'll just talk about stocks, has dropped. And I think you started off the whole talk. You had said of how you heard from Andrew about how the high frequency trading and the numbers that are out there, how much of that is in the marketplace. This is probably going to be even more stunning when you think about it. The volume is down probably 60 to 70% since the 2000 high in the market. On top of that, of the current volume that's down that much, probably I would say 80%, 90% is high frequency trading, meaning, and when I say high frequency trading, I basically mean the type of super short term, buy it and sell it for a penny higher kind of thing. So if you think of the old, I don't know, maybe it was Johnny Carson or other different things where the guy was like spinning the plates and keeping it going. That's pretty much what's going on. You've got one firm buying it, and then another guy, and they sell it to another firm, and then another firm buys it back, and then it's just back and forth, almost like call it patty cake. You could see it within charts. Sometimes if you look at a 1 minute chart, you'll see the candle bouncing up and down, and that's just basically building up all of volume. There's also been another couple things they've been showing. The volume of the last couple minutes where it's exploded in the last few years, and probably a third of the entire day's trading volume is done in the last 1 to 2 minutes of the trading day. So when you think about that, right, and it's basically I don't know, it's either market on closes or just one firm selling to another firm if they are stuff they already bought back earlier. So ultimately, the way I look at that is you've got volumes down 60, 70%, and then of that, probably a third of that volume is done pretty much on one print in the dark pools at the end of the day. So really, your volume's down probably 80, 90%. Then of that volume that's trading, probably 90% is high frequency. And when I say high frequency, I'm not talking about someone who has a trading system. They go and buy a trading system and they get in something and they hold it for 5 minutes and get out. I'm talking about stuff where people are in and out within seconds and making a penny or even a lot of sub-petting going on. If you look at a level 2 on stocks, I'll see it all the time. I've had it happen myself where you go to bid it filled. So they know they want your order. They know they can get in at that 1/10 of a penny or 2/10 of a penny in front of you, and then they can lay it off. So ultimately, it increases liquidity, but if that liquidity all steps away, then what? So I think the risks are pretty inherent in that type of structure. I think there are definitely some things trying to be done to fix that structure, but that's why I try and stay away from those type of stocks and those type of things, and I more focus on bigger, deeper, more liquid markets like Forex and lots of that kind of stuff in the futures market, but mostly Forex.
Sure. And the thing, I love the analogy you used about the guy spinning the plates. I think the concern that a lot of people who, understand the risk in a market, but maybe don't have any way to fix it. I mean, I'm just a guy in a basement in Utah, right? I'm sitting here looking at it, and the guy spinning the plates, these institutions, high frequency algo traders that are running money using leverage, when they drop the plates and they all break, they just go get another job spinning more plates, you know?
Right.
And so what's the real risk to these institutional traders? It's not their money they're really trading. They're working off of bonuses, right? And they can build wealth even if it eventually does have a crash and hits the system. I don't know what the answer to that is. I mean, it's just concerning when you really step back and think about it.
Well, I think that the system as it is set up where, you know, it's difficult to raise the capital and then build up the fund and do all the different things it is to start, like, let's say, a fund or an institutional style account. So I think that you have kind of checks and balances in there that do keep things. So you have to really be on the cutting edge of getting the right information, and then you'll be able to be profitable. But if you sat around and I think you had brought up earlier asking me about how I was when I was a broker, to put in orders, we had to write an order ticket out, walk it up to the end of the office where the woman was sitting at the desk, the trade desk. You handed it to her. She called up the New York Stock Exchange, got the clerk on the phone, who then would write down the order and then run that over to the
Matt, did you lose him as well?
That was Dave Kosourek and Andrew Cameron. You've been listening to the Trading Justice podcast presented by Tackle Trading. Tim, I'll tell you right now, Dave and Andrew is always highly impressive as well, but I was just so impressed by Dave's level of knowledge regarding, you know, everything we discussed: high frequency trading, algorithm based, how to create it, you know, talking about controlling risk and trading. I think the number one thing I heard from in terms of that made sense to me or spoke truth to me was getting out there and trading things that are very liquid, so that you can kind of minimize your risk to some of these black swan events.
Yeah, you know, and I enjoyed the conversation very much. You know, there was some parts of it that really made me sit back and think, which I like. You know, that's always a good mark of a conversation. I'll tell you, I mean, it's a crazy financial world we live in. Matt, you and I do this every day. We talk to traders. We work with retail stuff. The one takeaway I have from it on a personal level is that you should never stop trying to build your team. People, your network, the people in your life. Surround yourself with smart and educated people. You never know what you can learn. It doesn't matter if you are a pro. You know, you could be Peyton Manning. You still want somebody to sit there and go over the film, right? And help you understand what they're seeing out there. I loved his perspective. I thought it was a lot of fun. We'll have to have him back on the podcast and really dive into some of these economic reports that are coming up here in the future.
Well,
but
you know, honestly,
a lot of fun.
Honestly, it was a lot of fun, and you're absolutely 100% right there. When you're talking about always looking to build, always looking to grow, always looking to get better, we've been in this industry, you know, trading for a decade now. You know, combined 20 years experience. We live this market every single day. We've talked to more traders than we can count. We've taught more traders than we can count. But you know, I look forward to talking to Dave, you know, offline about just trading and getting his perspective on things, and I'm sure he'll learn from us too. Yeah. And I mean, that's what it's all about, is just getting better and growing. And you know, when you really never have seen an event like we saw last week with the Swiss, you know, getting somebody like Dave's take on it, who's been around the market for more than 20 years now. He's seen a lot that we haven't, and I thought it was a fascinating conversation, and I look forward to having more about that. And you know, Dave's an institutional trader. Dave runs a hedge fund. He's an algorithm-based trader, and you heard him say something at the very, very beginning. He said, "How does the retail investor, you know, not only survive but profit in these types of environments?" And what did he say? He said the same thing that we always say, Tim. You got to get educated. You got to learn a trading system, and you got to surround yourself with people who know this. And if you're not going to invest in that, then you shouldn't do it. And that's the exact same thing that we say. And honestly, Tim, that's the exact same thing we're going to say tonight when we do our online Rich Dad training here tonight. If you're going to treat nickel and dime this, guess what, guys? You shouldn't do it. Okay, you got to treat this like a professional.
And you have to commit. And if you're going to commit with a vision and a plan and the whole thing, follow through with it. Be that kind of person that follows through and actually gets stuff done. You guys have been listening to the Trading Justice podcast with Matt and Tim Justice. We've been talking institutional trading and, algo trading. There's all kinds of words for it. The Trading Justice podcast is presented by tackletrading.com. Get in the game. Come over there and join us in the clubhouse. Get a pro membership, and we would love to have you as part of our team. Matt, any last thoughts before we kick this one off?
We'll probably do another podcast before the ECB event on Thursday, but honestly, the ECB event on Thursday is a big moment for the markets. The markets have been pricing in quantitative easing for a while now, and like Dave said, they've been dragging the ECB's been talking this for more than a year now. It's been being priced in for the last 6 to 8 months, and unless they do something dramatic, I think the market's going to respond very quickly, and so I'm looking forward to trading that. And in fact, Tim, I'll be in Washington D.C., one of the greatest cities to ever exist, on Thursday morning, and I'm going to be getting ready to teach a wonderful group of students there in the D.C. area for Rich Dad Education, and there's going to be 100 people there, Tim. And as they're coming in and as they're preparing for their trading journey this Thursday, I'm going to be sitting up there with my screen down, and I'm going to be live trading that ECB event from 8:30 till the start at 9 o'clock. And I can't wait for it. Honestly, I can't wait for it because I think there's going to be a big opportunity there. And so I'm just excited about not only trading what's going to happen in the future. Honestly, Tim, I'm so thankful. After conversations with Dave and Andrew today, I am so thankful that 10 years ago we decided to educate ourselves, and we decided to join one of the greatest systems out there in Rich Dad Education. And because looking at it right now, the world is so different right now. The investment world, the economic discussion is so important right now in comparison to when we were going through in 05, 06. I mean, we didn't have the fear of the market then that we did now, and now we're armed with an arsenal of trading strategies and systems to combat to combat whatever lies in front of us. Because at the end of all of it, guys, a lot of what Dave said was a little scary in terms of the consumer out there.
Sure.
But for a trader, it's just information. For a trader, it's just price action. For a trader, it doesn't matter if it goes up or down, ladies and gentlemen. You can profit and change your financial future, the scope of your financial future, if you just have the courage to take a step and invest in yourself. And I'm just glad we made that decision 10 years ago.
Oh, I agree 100%, and that's why we're doing this. This is grassroots media right here, Matt. Whether we understand the depth of it or not, this podcast can grow, and we can bring information to people that they are not getting. I love what Dave said about the, non-traditional media. You have to get to people and actually listen to people who are got their boots on the ground, so to speak, and are doing that kind of stuff. So
it doesn't do you any good to listen to CNBC.
I can't remember last time I even had it on, to be honest.
You've been listening to the Trading Justice podcast. If you've enjoyed yourself and think that the conversations and topics we've covered are important, help spread the word. Give us your feedback. 5 stars on iTunes, like us on Facebook, and follow us on Twitter. The Trading Justice podcast is proudly sponsored by tackletrading.com. Get off the sidelines and get in the game.